Welcome to the results presentation for NWF Group. This is for the full year ending May 2019. I'm pleased to present a strong set of results and delivery of our strategic plan. If we now look at the results summary, revenue is up 10% to 671 million. It's grown as a consequence of increased commodity prices and activity across the group. The key number for us, as always, is the headline profit before tax. And at 9.7 million, that's a strong result ahead of original market expectations. It is a little lower than prior year, which was a record, and that had the benefit of 4 long cold months. If we then look at net debt at 10.4 million, that's less than 1 times EBITDA, so still at a comfortable level. And on the dividend, we're proposing an increase of 5% of the total dividend to 6.6 pence a share. That's it now 9 out of the last 10 years that we've increased the dividend by around 5%. And on the current share price of around 165 pence per share, that's a yield of just over 4%. If we now turn to the divisional operating highlights, I'll start with fuels. Strong performance here, led by Richard Huxley and his new leadership team. We've managed oil price volatility well, and oil has moved between $50 per barrel and $86 per barrel in the period, and right now $62 per barrel. We had a mild winter, but we've offset the lower demand for heating oil with increased gas oil sales, which has been effective, and we've invested in advanced systems and capabilities in the business. We've also importantly delivered 3 acquisitions, and that adds 5 depots to our network and over 20% increase in the volume that we sell. That's Midland Fuel Oils, which we've integrated into Kenilworth, Consols down in the southwest, which supplies customers across the Cornish Peninsula, and we announced this morning the acquisition of Ribble Fuel Oils, which serves businesses across the northwest and into West Yorkshire. So in total, we're now delivering over 600 million litres of fuel across the UK. Now turning to food, very strong performance here with profits up to 1.8 million. That's really as a consequence of winning nearly 28,000 pallet spaces of new business in the last 18 months. We've provided a high level of service to these customers and also have increased our operating effectiveness both in distribution and in warehousing operations. We have stored product to support our customers' requirements for Brexit, and that stock is now shipped. At present, we remain full and have a pipeline of new business activity coming through. And in feeds, we've delivered stable performance in spite of volatile market conditions. Overall feed volumes have been stable. The market was down just 1%. However, last summer, we had high demand for feed as our nutritionists looked to increase feed volumes to offset the dry conditions where the grass wasn't growing. And then counter conditions in the winter, we've had mild conditions, good forage growth, and therefore we're reducing feed volumes to maintain milk production. Prices have been aligned to commodities, where again there's been quite a bit of volatility with prices moving up over the summer and then reducing during that winter period. As always, we continue to focus on operating efficiency. We delivered over 590,000 tonnes of feed to 4,500 farmers across the UK. And therefore that focus on operating efficiency both within our mills and in our transport network has been critical.
I'll now take you through the financial highlights of 2019, starting with the income statement. Revenue increased by 60 million in the year. 45 million of this was due to commodity price increases, 7 million was due to acquisitions we made in the year, and £8 million was due to increased activity, particularly in our food division. This resulted in headline operating profit of 10.2 million versus 10.6 million in the prior year. But in the prior year, we had the benefit of the beast from the east and the extreme weather conditions. And this is best shown by the table at the bottom of the slide, which shows the profit pence per litre that our fuels business has made across the last few years. You'll see that last year we achieved 1.3 pence driven by the extreme weather conditions. But our average over the last few years has been 0.9 pence. Therefore, the 1 penny we achieved this year was a very strong result and is in line with our normal target for that business. That has resulted in a statutory operating profit of 9.6 million. Our headline profit before tax is 9.7 million, which is only £500,000 lower than the prior year when we had the benefit of those extreme weather conditions. That results in a headline EPS of 15.8 pence, and as a result, we are proposing a full year dividend of 6.6 pence, which is a 4.8% increase on last year. Moving on to the balance sheet, our net assets have increased in the year, as have our total assets. We have had a working capital outflow in the year, and that reflects a very busy May, plus some short-term payments to suppliers around the year end. Our return on capital employed was 13.4%, which is a strong performance given the absence of extreme weather. Our pension deficit tracked lower across the year, but has ended the year at a similar level to the last financial year. This is largely a result of a movement in the discount rate from 2.75% to 2.5%. Our next triennial valuation will be to the 31st of December 2019. Until that is concluded, we'll continue to make contributions of 1.8 million per annum, and at that level, it is not constraining the development of the group. Looking at our net debt movement across the year, we typically aim to generate 2 to 3 million of cash before development expenditure, assuming neutral working capital. This year, we've generated 0.5 million, but we have got those short-term working capital differences. So if we add those back, again, we're in line with our 2 to 3 million of cash generation before development expenditure. We have considerable facilities available for group development, the majority of which is a 50 million invoice discounting line. Our average net debt across the year was just north of 20 million. Therefore, we have significant headroom for future development, and our bank is very supportive of our future strategy.
Now, turning to our development strategy, just a few key things about NWF we need to remember. First of all, we have a diversified source of earnings, and critically, we have a very good cash generative business. We've got an experienced, capable board, and we're very focused on total shareholder return and have a strong track record. If I look at our fuels division, the focus here is about consolidating a very fragmented market. In food, it's all about improving the operating efficiency of our warehouse space, principally in Wardle, where we've got 100,000 pallets. And in feeds, it's all about consolidating the market, principally for dairy, where we feed 1 in 6 dairy cows, and also broadening the offer of products we supply to 4,500 farmers up and down the UK. I'd now like to focus a bit more on fuels because we've made real progress here and there are significant opportunities going forward. If I start with the market, and you can see on the pie chart there, it's a very fragmented market. The top 10 players have less than 25% of the market. That big grey pie is 75% of the market, 150 small fuel distributors. NWF today has over 600 million litres of fuel, but still represents less than 2% of the market, with a small red pie segment you can see on the chart. The market for fuel on the left-hand side is stable and growing. This is the global demand for energy, which is increasing significantly. If I look at the UK market, the demand for oil from the government's own latest forecast is stable over the next 20 years. So we have a long-term market. We also have an opportunity for consolidation. If I then now look at our performance in the last 12 months, you can see we've made some significant moves. We've acquired 3 businesses in the period. That delivers over 110 million litres of extra fuel into our network. And we've spent over £8 million on the acquisitions. We've acquired Midland Fuel Oils in December, which has been integrated into Kenilworth, Consul Oils in Cornwall, which we acquired in April, and in July we've acquired River Fuel Oils in the northwest, which has 4 depots taking us into Cumbria for the first time and also into West Yorkshire. If you now look at the map of the UK, you can see all of the depots that we've got across the UK, now 23. And what we've got is a clear roadmap for expanding this network further. We're targeting oil distribution businesses in the UK. And we've got a clear valuation and pricing strategy and a clear post-acquisition integration plan. Critically, what we do is we'll keep the customer-facing parts of the business, so the brand, the phone number, and the website, and indeed the customer service person and the tanker driver who's going to deliver your fuel. We'll then integrate the back office functions, so that's things like finance, IT, purchasing, and credit control. And positively, we've got a strong pipeline of future opportunities in this space. So finally, in terms of summary and outlook, it's been a strong result in 2019, outperforming original market expectations. We've demonstrated the delivery of our strategic plan with the 3 acquisitions in fuels. We've got a strong balance sheet and long-term funding in place to support future development. Regarding Brexit, we operate in large, UK-only, stable markets which really are linked to the size of the UK population. And we're currently trading in line with the board's expectations in all three businesses. So we continue to have confidence in the future development opportunities for the group. Thank you very much.